The Minority Market. Episode 32. How Market Psychology Shapes Every Move. Every candle you see on a chart is not just price movement. It is a visible record of human emotion. Fear, greed, hope, panic, confidence, and hesitation are all embedded inside those candles. The market is not driven only by numbers or news. It is driven by collective psychology. Until you understand this, you will always feel confused by sudden reversals and irrational behavior. Most beginners believe the market should behave logically. They expect price to rise when news is good and fall when news is bad. But reality is very different. Often, markets fall on good news and rise on bad news. This happens because markets move based on expectations, positioning, and emotional reactions, not just facts. Market psychology works in cycles. When prices rise consistently, confidence increases. Confidence turns into optimism. Optimism becomes greed. Greed creates overconfidence. Overconfidence leads to excessive risk-taking. Then one unexpected event triggers fear. Fear turns into panic. Panic becomes capitulation. After that, exhaustion sets in and smart money starts accumulating again. This cycle repeats endlessly. The minority learns to recognize these emotional phases instead of being controlled by them. When the crowd is extremely optimistic, the minority becomes cautious. When the crowd is fearful and hopeless, the minority starts observing opportunities. One of the strongest psychological forces in markets is herd behavior. Humans naturally follow crowds. When everyone is buying, it feels safe to buy. When everyone is selling, it feels safe to sell. This instinct comes from survival psychology. But in markets, this instinct often leads to poor decisions. When you buy because everyone else is buying, you are often late. When you sell because everyone else is panicking, you are often exiting near the bottom. The minority trains itself to pause and question crowd behavior. Another powerful psychological factor is loss aversion. People feel losses more strongly than gains. Losing 1,000 Indian rupees feels more painful than the happiness of gaining 1,000 Indian rupees. Because of this, traders hold losing trades too long and close winning trades too early. They want to avoid the emotional pain of accepting a loss, so they delay it. This destroys long-term performance. Market psychology also explains why support and resistance zones work. These levels are not magical lines. They are memory zones. Traders remember previous highs and lows. When price returns to those levels, emotions return with it. Fear, hope, and hesitation appear again. This collective memory creates reactions. Another psychological trap is confirmation bias. Traders search for information that supports their existing belief and ignore anything that contradicts it. If they believe the market will go up, they look only for bullish signals. If they believe it will go down, they look only for bearish signs. This blinds them to reality. The minority practices neutrality. They observe price behavior without emotional attachment. They allow the market to show direction instead of forcing opinions onto it. Revenge trading is another emotional mistake. After a loss, many traders feel the urge to recover money quickly. They increase position size, enter impulsively, and break rules. This behavior comes from emotional pain, not logic. The minority understands that one trade does not matter. Only long-term consistency matters. Fear of missing out, also called FOMO, is another major psychological driver. When price moves fast, traders feel pressure to enter immediately. They fear being left behind. This leads to poor entries and emotional stress. The minority waits patiently. They understand that opportunities are endless, but capital is limited. Professional traders spend more time managing emotions than finding setups. They know that the biggest enemy is not the market. It is the human mind. This is why mindset training is more important than strategy complexity. You must also understand that you are not separate from market psychology. You are part of it. Your emotions influence your decisions. When you feel excitement, fear, or frustration, you are experiencing the same emotional forces that move the crowd. Awareness is the first step toward control. Here is a simple practice. After every trade, write down what you felt before entering, during the trade, and after exit. Over time, patterns will appear. You will see how emotions influence your behavior. This self-observation builds emotional intelligence. Another important habit is slowing down. Fast decisions increase emotional mistakes. Taking a pause before entering a trade allows logic to override impulse. The minority builds routines that reduce emotional reactions. Market psychology also explains why discipline beats intelligence. You do not need to be the smartest person in the room. You need to be the calmest. Emotional stability creates consistency. When you understand psychology, charts become easier to read. You stop seeing random candles and start seeing crowd behavior. Breakouts represent excitement. Fakeouts represent emotional traps. Consolidation represents indecision. Trends represent confidence. This shift in perception changes everything. The minority does not fight emotions. They acknowledge them, manage them, and design systems that reduce emotional damage. As you continue this journey, remember this: mastering the market starts with mastering yourself. The market is a mirror. It reflects your discipline, patience, and emotional control. This is how market psychology shapes every move. And this is how the minority stays ahead.